one thing while I think about it, please. You know, what I did on the test was I prepared a test for you guys, and then I took the one I was using to sort of prepare the new one and changing all the numbers and everything, and I put spring of 2015 on it, and it was exactly the same test. It wasn't just the same on a couple problems, first page and last page. The whole thing was the same. But it worked out pretty good because the three people that are redoing it didn't do any better than anybody else. So I guess it's all right. Anyways, I apologize for that. But that's what happened. I gave you the same test as the last spring. Wait a minute, it's the exact same test all the way through. And I went and looked, yeah, the other one sitting there too. I set up the wrong one. I apologize for that. Not I guess. It was still hard, wasn't it? Yeah, okay, yeah. So, bad enough, yeah. So, and the people who had done the exact one before, well, they were sick and whatever. And so they didn't remember doing it anyway, and apparently didn't study directly from it, so that's why. Not for you,
actually, I actually had a couple of questions as far as some of these. Did you say the exact same one, right?
Yeah, I don't know. Maybe I changed some numbers or something. I don't think I did, but
They don't seem like
well, maybe it's not exactly. Maybe it's close. Okay, anyway. So, you have a particular one you want to look at? On 47. Okay. 47. Which one? On the first one? Okay. Insurance expense in the income statement was. We'll do it real quick. We don't want to spend today doing the whole test, of course. But we will in review sessions, right? Getting ready for the test, whatever. Okay, let's see. What accounts are we going to be working with here? Looks like insurance premiums paid, prepaid insurance, insurance expense, right? So probably prepaid insurance and insurance expense. Sound good? I'd start with nothing in insurance expense when I start a year with you guys. Prepaid insurance starts at $3,000, goes down to $2,400. Is that right? So it looks like we used $600 more than we bought. And then it says the insurance premiums paid were $20,800. So that would probably be debit prepaid insurance $20,800. That makes sense. Credit cash $20,800. So that gives me $23,800. And if I take $2,400 away from that, that is $21,400. Is it? I think. And that is the answer. Did you switch the beginning and ending balances or something? You know, you might have switched these two. That's a real common mistake. Annoying, right? Got it? I did do it right, didn't I, guys? All or I didn't. My calculator did it. You said you didn't really say that. Your calculation. Okay, yeah. My calculator malfunctions. Actually, that happens sometimes.
Can we really quickly do C on 53?
Oh, jeez. I knew I shouldn't have let that box open. Yeah. 53C. Expired insurance at 12/31/13 is $25,000. Okay. So what I do is I look at insurance expenses 30, right? And prepaid insurance is nothing. Is that right?
Yeah.
So I think 5, or it needs to be 5 left in insurance, less in insurance expense, doesn't it? When you credit insurance expense?
Yeah.
For 5, and debit prepaid because it has not expired? For 5? How can you people miss these? It's really simple. Just got to get yourself to think, right?
That's saying at the end.
Relax and think and figure it out. That's what I want you to do at work, right? That's what I want you to do at work.
Yeah.
No panic. No panic. By the way, some of you might have panicked on this too, huh? A little bit? Reflecting your scores? Stop panicking. It's a waste of time. Right? Do the work. Do the work. Do the work. Get yourself ready. Then come in, relax, and do it. Okay? That's how this is going to work. Okay? You guys can all do it. You're all really bright people. So, that enough? Good. Let's talk about Chapter 4. I looked at the syllabus, and we've got Chapter 4 and 5 really go together. They're going to be on the same quiz anyway. It's theoretical stuff, but it's also preparing financial statements in detail, so it's all kind of blended together. And so, and there's some new things you guys didn't see in principles of accounting, actually quite a bit of new stuff. So really emphasize the new things, obviously, get everything else down. Okay, so just keep going, don't let up. How many of you have now read Chapter 4? That ought to be unanimous, it's pretty close. Okay, good. All right, yeah, keep going, don't let up. And when you read in depth, right? You read slowly. You know, if you look at my book, looking at this one, it's in that way because I got a new book. Just bother to read it, it's so close. Right? But if you look at my book when I read a book for the first time, almost everything is yellow. I use a yellow highlighter. And the reason I do that is it slows me down when I read. Doesn't mean I go back and reread it. But almost everything is highlighted because in these chapters, almost everything is important. They really don't waste your time in this book. It's a big, thick mother, isn't it? And they don't waste your time. They don't repeat themselves very often. They really don't. They don't just go in circles like I do, right? They go right to the point. Make sure you get everything. I told you all the footnote stuff. Anything they've highlighted, oh my God, that, right? They know how to highlight what's important. Okay, of course. Anything that's in one of those boxes, oh yeah, know that, right? Those aren't just for fluff. So in other words, everything. All the footnotes, all the appendices, know everything about everything. Okay, that's where you want to be when you're done with this. Okay, so let's start over on page 177. In fact, maybe first start on page 178. We were talking about this last time. We talked about the basically short form, right, and long form, right, statement. Yeah.
When did you say the review session was for this?
Not until, yeah, it's a while because we're going to have, we have today on Chapter 4, right, or, yeah, today on Chapter 4, and then Friday on 5, next Monday on 5, Wednesday on 4 and 5, right, and then, this is a lot, there's really a lot in here, and then on Wednesday the 11th, we're going to do a review session. Anybody know what time it is? I stuck the paper somewhere. Everybody got it down?
1 to 3.
1 to 3. Okay, 1 to 3. And it's in here, isn't it?
Yeah, 460B.
Yeah. Okay, so that's on the Wednesday. You have that email I sent you? Well, actually, did I post that out on the Moodle? When the review schedule was?
It was an email, it wasn't on there.
I sent an email. Maybe I should put it in Moodle. If somebody thinks of it, email me and tell me to stick it in Moodle. You can look at it if you don't have to email anymore. Yeah. Okay. All right. Anyway, we were talking last time on page 178 about, I don't know if I was on that page or not, but probably. This is an income statement for a merchandising firm, right? Or, somebody selling merchandise, manufacturer, wholesaler, retailer. But anyway, you know the regular income statement. You know about separating operating stuff from non-operating, right? That's what's going on here, right? The operating stuff is sales, revenue, cost of goods sold, gross profit, selling and administrative expenses, income from operations, other revenues and gains, and other expenses and losses, right? You guys already knew all of this stuff, okay? And then what we call that income from continuing operations before income tax. By the way, if you don't have any of those items down below, you just call it income from operations before tax, or I'm sorry, net income before tax, right? It'd be net income before tax if you have nothing down below. Does that make sense? Okay, or income before tax. And then you take away the tax and get your net income. But here, because we have things down below, we call it income from continuing operations. Now, I want to emphasize, operations is the term for what? Revenues, cost of goods sold, right? Operating expenses, non-operating stuff. Well, non-operating stuff, is that in operating? No. So notice we get down to income from operations after we're done with operations, our normal recurring stuff, stuff that we're in business to do, right? That's before the non-operating gains and losses. the things that are what? Peripheral to the business. Remember those definitions? So the stuff that's peripheral to the business, the gains and other revenue items, maybe rental income, that sort of thing, right? Okay? Things that we're not in business to do, but we just happen to have some of it. Okay? Right? Peripheral. Okay? And then the same thing with the non-operating losses, right? Selling assets, maybe. Refinancing debt, maybe, right? And the non-operating expenses, right? Those go down below there. Okay? But then look what we call it. It came after income from operations. Everybody see that? But before income from continuing operations. Real unfortunate. We use the term operations for operations. And then when you put the non-operating stuff in, we call it from what? Continuing operations. It's really awful. But you need to know that. Real important to know the difference between those. Everybody got the distinction between operations and continuing operations? Continuing operations includes the non-operating stuff. That's all. Everybody good? We got it. We got it. Okay. What if something is unusual and infrequent? What do we call it?
Extraordinary.
It's extraordinary. Where's it going to go?
Below
Down below net income, which we say below the line. What if it's one, and the line we're talking about is income after tax, okay? The line we're talking about is income after tax. Income from continuing operations after tax. That's the line. Everybody calls it the line, okay? Sound good? All right, so it comes after that, okay? Where would discontinued operations go? After that. What if something, though, is either unusual but not infrequent, or infrequent but not unusual? It goes up above. That's by definition the non-operating gains and losses. Got it? You see the distinction? So you're going to be making that choice. And they're going to give you things that are close. In fact, look at this. They have loss on disposal of part of textile division. See that? Everybody see that line? It's up there under other expenses and losses. See it?
Yeah.
Okay. Are you guys getting better at reading financial statements? You're going to be really good by the time we get done with the whack cap-in stuff here. Because you're going to look at real financial statements and analyze them and pull information out of them. You think you ought to be able to read financial statements, you know, if you're going to be responsible for helping people prepare them and make sure they're right? Yeah, it might be a good idea. Okay, yeah, the first step is reading. Okay, so we're going to read real ones, and this is sort of the tip of the iceberg here. But you know what? All the statements look kind of the same. There's a variation, lots of flexibility, but it's kind of in the same format. So you need to know what the format is. You need to be able to put one together, of course. So I'm going to ask you to do that. Okay, put everything in the right place. What if I gave you a list of all of these items that are on here, put them in alphabetical order? Could you put them where they go? If not, just so you can. Fast. Same with balance sheet. Okay? Not kidding. That kind of thing. Okay? So, and I won't tell you whether they're debits or credits either. Okay? You guys know contra asset has a credit balance? Yeah. For instance. So you know what you're doing. Okay, anyway. Here's the other thing. Notice that after income from continuing operations before income tax, we of course have income tax. That's income tax what? It's not income tax. It's not prepaid income tax. It's not income tax payable. It's income tax expense. Yeah, we don't put the word expense on it, but it is. Or you might call it provision for income tax. It's income tax expense, right? So that's the income tax on everything above the line. All the revenues and all the expenses above the line, right, are pre-tax. Would everybody agree with that? You put your revenues in before tax. You're going to take the tax out on that line. You put all your expenses in before tax. You're going to put the tax on that line. Does that sound good? That's of course what's happening. Now notice you took the tax out from that income. So we got income from continuing operations before income tax. We take out the tax. We got income from continuing operations now. If you want to put something on the income statement below that, what did you better do? Show it net of tax. Right? Okay, now think about this. If I put on my tax return another $1 of income for these items down below, right? I add $1 of income on my tax return and I'm in a 30% tax bracket, what happens? 30%. The government's going to take 30% of it, right? They can take 30 cents and I get to keep 7. Would you agree with that? Everybody agrees with this. So what I would do is I would show whatever the gain is, and then in parentheses, less, what do they do? Yeah, less applicable income tax. I would put it in parentheses. You don't have to. They put it on the, the same, but I put it in parentheses. Parenthetical disclosure. That's called. Okay? Big deal.
All right? And so you could say less the applicable income tax. In fact, they didn't even have to show what the loss or the gain was, do they?
They can just show the net, because, you know, we're capable of adding the net to the tax, getting the total. That's fine. Come on. Okay? One more time. And this in principles, we'll do it in here. If you didn't do very well on this test, or as well as you wanted, how many people in here did as well as they wanted to? That's impossible. That'd be 100%, right? Want it all, right? Want everything done right. I love it when I actually do something and I get it right. It almost never happens, right? I screw up all the time. Okay. Don't be depressed about where you are and be thinking about where you are on that kind of sense. What should you be worrying about right now? Doing this. When you screw up at work, what do you want to do? Work hard. Really hard. Right? Gotta fix it. Not just fix that problem. It'll, you know, oh, I screwed that up, but this next thing was fantastic. I've sat in lots of meetings talking about performance evaluation for people, and somebody will say, well, you know, they really screwed that up. Oh, yeah, let's get everything else they did. That's just so I can remind you, because it was a real pain in the ass for you. But look what they did here, 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 and here. Are you kidding when I get rid of them? Okay? You're a crazy person. In fact, you're crazy not to have them on their job, on your job. Start doing that. Because I love them with my job, so I'll take them. Don't worry about it. A partner's just sitting there and you're saying that. Right? You're a manager. Right? It works. All of a sudden, the boss goes away. You know, it's like, you know, this other senior, this other manager is just a pain to work with. We have to think that. Of course, that's why that kid could do a good job with them. They don't train anybody. Right? Which that's why we have people that are impossible to work with. I had a guy when I transferred to San Jose with Arthur Anderson. I started in Seattle. Things were too slow. I was an aggressive little kid. But anyway, it was too slow. It took a long time to make senior there. And people were making senior really fast down in San Jose because that was when Digital Equipment Corporation was taking off, you know, the computer manufacturer, and they were just going crazy. And a number of other companies, of course, so the computers were just taking off. And so the industry was just getting going. So San Jose was the center of the hotbed of it, just going crazy. So I transferred down there. I went from being an inexperienced assistant to experienced assistant by moving. There's a step in between called assistant. I didn't do that part. So I was doing work I had no clue on. And the seniors who were helpful typically, you know, although under a lot of pressure and stuff, because they were way over their head too, because they didn't promote it too fast, right? Seattle would take forever. They promoted maybe 4 years. San Jose, a year and a half to 2 years. No kidding. So I'd been with Arthur for 6 months, so I went down there. And I went to work for this senior, and he just destroyed me in evaluation. I never experienced anything like it. I was doing really well at the firm. I thought I went to the training school, you know, got good reviews and everything. And yeah, the seniors all liked me, and there were things that they didn't like me, but they liked the work. You know, things are working good. And this guy just trashed me. So the manager called me to his office. He says, well, just don't worry about that. I'm like, what? It's horrible. He says, well, yeah, but everybody who's passed the CPA exam early, like you, did a horrible one. Because he should be a manager now, and he's still a senior, and he can't make manager unless he passes the CPA exam, and he seems to have a mental block. So he knows that the firm's going to fire him if he doesn't pass the CPA exam. So he hates you. You told him you passed the exam, didn't you? So he asked me. He says, I should have warned you. You could have lied. Said you had. You would have been off to help you. He just left me out there to screw everything up. Then when I screwed everything up, he wrote me a bad evaluation. That's what I do to you guys in these tests, don't I? Yeah, pretty much. That's what I do. All right. So relax about that kind of stuff, you guys. When you screw something up, go for it. So right now, go for it. Okay? By the way, how many of you have never screwed up anything in your life? Ever? Yeah, good. Okay. So you're used to it, right? It's no big deal. I'm screwing up today's class. I screw up every day's class. You can get used to it. Anyway, let's see. So what else do we need to talk about? Oh, notice that they've got the loss and disposal of textile division I mentioned. And then down below, they have loss on the disposal of a division. What's the deal? Is it a significant portion or not, right?
What is part after what it is?
One's part, yeah. So if they say part of, I guess that means it's not that material. You have to make a judgment. How about if Lay's potato chips, whoever owns the company, Lay's potato chips, how about if they get rid of sour cream and onion? Do you like that flavor, potato chips? They keep every other product they've got.
It's not discontinued.
That is not a discontinued operation. What if they get rid of all of their snacks? Every kind of chip they have? I think so, right? Would you think so? Yeah, so you use your judgment is what you do. What if they get rid of the entire East Coast to keep the rest of the country? If they get rid of the entire Eastern Seaboard, they're not going to sell there anymore. Call. Probably, right? What if they get rid of Vermont? They hate Vermont. They're not going to sell products there anymore. Probably not. Not big enough. Not significant enough to. How about if they get rid of California? Or New York? A lot of people. A lot of people. Maybe that's big enough. It's going to be judgment, okay? On the CPA exam and on my exams, we'll make it onto this part of, it's all of, okay? So you got to make it. You got to make the judgment call. Okay. Now I was talking about the taxes and lost my train of thought. Sorry. Went on to something else. If it's more income, I have more tax expense, right? So you show the gain less the tax impact down there under discontinued operations or extraordinary item, right? What if it's a loss? What happens? If I add $1 to loss to my tax returns, right? What happens? I lower my taxable income by that $1, right? If I'm in a 30% tax bracket because I have income from everything else, right, from my operations. If I'm in a 30% tax bracket, what happens? What just happened to me if I put $1 loss on my tax return?
You can pay less in tax.
I'll pay less in tax. I'll save 30 cents of tax. So what's my net loss? It's not $1. What is it? 70 cents. Everybody agree? This is true, right? You ever heard people say things like, this is funny. People say when somebody who's wealthy, entertainers and stuff, you know, people who athletes have a lot of money, they donate money to charity. Have you ever heard somebody say, well, that doesn't really cost them anything, they can write it off in their taxes? That's not true, of course. They can write it off in their taxes, but it still costs you. What tax bracket would you have to be in for it not to cost you when you give away $1? What, 100%? Nobody's in 100%, you guys. Maximum's now 35, right? So if you do, which is ridiculously low, by the way, 7, yeah. Actually, at one point it was 90, which is a bit high. 7 is probably reasonable. If you're making hundreds of millions a year, but otherwise you become society, which is why we have massive deficits and huge natural debt. Because we don't pay our bills. Because we collect enough taxes. Kind of it. Yeah. So we have to collect taxes. What we're going to do now is we're going to have more sales tax. So poor people can pay the taxes instead of rich. That's good. It's horrible, I think. But they don't have the money to pay the tax anyway. So then you have to have more social programs to give to poor people because you made them poorer by taxing. That's good. That's going to work out well too. It's a mess. Anyway, our taxing policy in this country is crazy. But what's the deal? If I have a tax benefit, what would I do? I'd have a loss. Maybe the loss was $100,000. I'm in a 30% tax bracket. I save $30,000. What would I put here? Loss of 70, right? Show 70. And you put in parentheses, net of tax what? Benefit. I get a tax benefit for the loss. Everybody good? That's basically it. Okay? No big deal? So when you're looking at this, well, of course everything below the line has to be adjusted for the tax impact. Okay? And then earnings per share I mentioned last time too. What's the deal on earnings per share? Where do you start it? Yes, it's from income from continuing operations and what? And everything thereafter. It's not before tax, right? It's not the before tax income from continuing operations. It's income from continuing operations, which is the line. See the 276,000 there? Here, I guess they have, what, 100,000 shares, and they go into 276,000 to get $2.76. Got the idea?
Oh, I see.
So you do, and then every line below that, that's all you got to remember. Do income from continuing operations, right? By the way, what if you don't have anything below the line? It's just on net income. Got it? Everybody good?
So per share of common stock is on net income, yeah? Everything else is on...
Earnings per share is from income from continuing operations and everything thereafter. If there are discontinued operations and there are extraordinary items, you do them on those too, right? Notice they did every single line. And all we're doing is that do it. But if you only have net income, right? If you don't have discontinued operations and extraordinary items, you only have one line for earnings per share, right? Be net income after tax divided by the
equivalent weighted average number of shares. What the hell is that? Luckily, it's going to be in a later class. You can do that with debt.
We're not doing the calculations, we just have to figure out where to put it.
Well, you're going to do the calculation by, I'll tell you how many shares it is. I'll tell you what the weighted average number of shares were for the year, and then we divide it in. And you know what, it's even worse, we do fully diluted and undiluted. Fully diluted is if all your convertible bonds got converted to stock, your convertible preferred stock is converted to stock, we'd have more shares, so we calculate a what if. I think it's silly, by the way, right? But we do. We show a whole bunch of earnings per share stuff, right? Okay, I don't want to keep the shares earnings per share that they do. We can talk about that when we get to the whack cap and stuff. Finance, you can figure out those who do budget finance. Earnings per share average. Right? Grid just really dumb. It's just net income divided by the number of shares. Come on.
Yeah.
It's the same thing. And it's a line after line after line after. But anyway, that's what we do. So you're required to show it, right? But it's going to be an easy calculation. As soon as you've got the income statement done, down to net income, what do? You take income from continuing operations and every line after that divided by the equivalent number of shares that I give you, right? And write it down. Okay? So that part's going to be easy. But you need to know it for the CPA exam, so I'm going to test on it, okay? Everybody got the idea? And then you can worry about doing fully diluted and undiluted and all that stuff, computing the weighted average in a later class. Okay? So here it's going to be simple. Okay? And that does get to be kind of a pain, by the way. Okay, anyway, so you got an idea what the income statement looks like? Oh, by the way, in the income statement, do you put for the year ended or a specific date? For the year ended. Why? Because you close the books and just added up the year. It's only for a year. What do you do in your balance sheet? So you never close books. You don't have to say yes, nobody does it. Okay, except for office and textbooks. They always do that. I don't know why. I've never seen anybody do it in real life. What do? You just put the date. Just the date. So that's fine. Do it that way. Okay? What do you do on a cash flow statement, seeing as you start with beginning cash and work down to ending cash? Or the year ended. What do you do on an equity statement, seeing as you start with beginning equity, with beginning balances in the equities and go down to the end? For the year ended. And why did you guys give me a retained earnings statement, a bunch of you, when I asked for an equity statement? And those of you who did try to do an equity statement, put it all in one column. Didn't you read the book? Very careful. Okay? So I don't think anybody gave me a proper looking equity statement, so in the next chapter we'll do it. Okay? There was one page where they showed you how to do it. They didn't show you how to do it, they showed you exactly. There's a column for common stock, column for additional paid-in capital, column for preferred stock, column for additional paid-in capital and that, column for other accumulated comprehensive income, and then a column for retained earnings appropriated, a column for retained earnings unappropriated. It's a big spreadsheet, goes side to side, right? And then there's a total column, right? That's how it's done. Okay, total column for all the equity. But anyway, it wasn't terrible. We lots of points to there. All right, big deal. So let's talk then about some of the stuff in here. What's the deal? Back over on page 169, we had unusual gains and losses, discontinued operations, extraordinary items, non-controlling interest. Where do you put what are some examples, by the way, of unusual gains and losses? Take a look on page 169. Losses on a write-down or write-off of receivables, inventories, property, plant, and equipment. These are not in the ordinary course of business, right? They're not what you're in business to do. And they're either unusual or infrequent, but not both. Got it? That's the idea with each one of these things. Gains and losses on exchange of and translation of foreign currencies. Okay. Now that's not the stuff that goes into the other comprehensive income, right? This is when you actually exchange the currency and actually have the gain or loss. You realize it. You're not just recognizing it. Okay. The ones you are just recognizing where you haven't actually translated the currency. We got euros and we have not converted them into U.S. dollars. We'll still have a gain or a loss, but we haven't realized it yet. Why not? We haven't converted the currency. And it might be temporary, because exchange rates keep changing, right? Everybody got the idea of this thing? Okay? So that stuff is going to be another comprehensive income. It's not even going to be on the income statement. These are items where you actually converted the currency. Okay? Exchange the currency. All right. Let's see, restructuring charges. This one's big. Companies love to restructure. And then they can take what I think probably should be ordinary operating expenses, and therefore a loss from operations, and pull it down below the line. Oh, not below the line. Below income from operations, right? But before tax.
they have a line called restructuring. If you see restructuring every year, public company, 3 years income statements are shown for public companies, right? In their annual report, right? They have to do the most, this year and the 2 most recent, of course. Okay, so there's 3 years there, right? If you see restructuring every year, come on, give me a break. Finance types, when we do whack cap in, if it's there every year, I move it. I pull it up into regular operations. Full. What if they do it once every 20 years, restructuring? It's probably a real restructuring of the company, right? Sold off a bunch of assets, reorganized everything. But if you're doing it every year, come on. That's an ordinary course of business. So we have to use some judgment here. And when you're working as an accountant, and you're preparing the statements, you should be applying the same judgment. Don't let your boss get away with that. Don't take stuff and put it down there in non-operating to operating. That's ridiculous. Right? You're trying to mislead people, I think. Make it look like you have an income from
So would it go under
operations.
loss?
Huh?
Would it go under loss then?
Well, no, you'd put it up, it might be a loss, but it'd go up, you could put it up, the restructuring, I have it in salary expense and, just so I got it before operations.
Break down like the individual expenses from it?
Yeah, and just call them what they are. So what people like to do is suck all the expenses out, put it into restructuring and put it down below there. Does that make sense? Yeah. So, look at, on page 169, the restructuring, the number of them, in a recent year by 500 large companies. Give me a break. 202 restructurings. What, are we just changing business totally every year? The write-downs, gains, losses, and sale of assets probably makes a little more sense, right? Because those probably actually happen out of the ordinary course of business. But again, if it's normal course of business, you ought to call it a normal course of business. I had a client, when I was teaching at Washington University, I worked with a CPA firm in Yakima, Washington, and sort of consulting basis, I suppose. An outside independent reviewer, I come in and review their work papers for audits, and I made more money there than I did at Central Washington in my spare time. Public accounting pages, teaching stuff. But anyway, it was nice. But anyway, I was working on this account, and I started realizing, geez, guys, they have more sales of equipment than they have revenue. It's an asphalt company. They're paving roads. They had all kinds of grading equipment. So they dirt movers, and gravel spreading, and dump trucks, and all that stuff, right? And they had far more equipment than they could possibly use all the time. And they sold more equipment than they sold of revenue. And I said, these guys are a used equipment dealer. They're not just an asphalt company, road building asphalt company. They're an equipment dealer, right? They're in 2 businesses. It's both from operations. And they, whoa, no, we're not an equipment dealer. And you know what was going on? They would, every time the economy would turn down and there's no road building going on because counties and cities and the state, weren't building any roads, the bottom fell out on the industry, right? And what they do is they'd go buy up all the equipment from the companies who were going bankrupt. They bought it for almost nothing. And then, while the economy was slow, they'd repair all that equipment and get it ready to sell. Because the people going bankrupt, of course, didn't take good care of it because they were going bankrupt. You know what happens, right? They weren't maintaining things properly. So they fixed all this equipment, painted it, the engine rebuilds, the whole thing. And they kept their maintenance crew busy instead of laying them off. So they kept all these really great people working for them. It was a great business strategy. Then when the economy fired up again and there's all kinds of road building going on, of course they started building roads themselves. And they sold all the extra equipment to other people who were starting road building operations. And they made a fortune selling it to them because such things was real valuable. They made far more money selling used road building equipment than they did building roads. So they were government contractors, you get paid very well for it, right? Very small company. They were thrilled with this change. You know why? All their income was down in non-operating, right? And I moved it all up into operations because that's what it was. So it's not always a negative that we do this, right? They were thrilled with it. And the people at the CPA firm were kind of, well, yeah, but we've always recorded it this way. Like, who cares? It's wrong. Why don't you record it right? Let's fix it. Let's put it where it is. But the company still didn't like the idea that they were, a used equipment dealer. They didn't like that. I don't want to be a used equipment dealer. I want to be a contracting company to build roads. Yeah. See.
that? I heard that somebody. Did you say not really? Is that you? When I said, did we cover anything, you said not really.
Do you have an income statement?
She's gonna deny it.
Do you have an income statement that has a full, list of everything that's in this chapter?
Actually, that one has it all. That one has it all. The later stuff in the chapter is not on. So the one on, well, what it doesn't have, one piece of it, the non-controlling. So you have net income. But everything else is there.
Yeah, but see, look, that looks different. That's got some different stuff in it.
Oh, yeah, this is only part
I
of it.
mean, this has got income before income tax, income from operations, interest expense.
This should be. When you go over here, there's still, they could have interest expense here if they wanted. They probably just put the interest expense up in here if they have any interest expense.
Okay.
Right, so it's just another company. You don't have interest expense, but it's still good. It's either got to be in the non-operating area. Some people like to do that here. Some people go ahead and put it up as self-administrative. Or another line.
All right, so
which I like better, by the way, personally, because I think it's a cost of operations for most companies.
So this format here is the correct
This
format.
is pretty much everything. Yeah, but so are the other ones. What if you don't have extraordinary, you don't list them? What if you don't have discontinued operations, you don't list them?
I'm also talking about grammatically as well. Like this says income
Yeah.
from continuing operations.
This
but
one's
then,
right, the other one's wrong.
But this has got it.
This should have income from continuing operations before tax, and then income from continuing operations. Why do you add that in there? This should be income from continuing operations before tax, right?
Income from continuing, right here, right?
Yeah.
See,
Before.
they've got income from operations, then they've got interest expense, then they've got.
Yeah, they put this in non-operating. Everything above there is from operations, right? And this is their non-operating, one non-operating item. And then this should be income from continuing operations before. Does that make sense?
Yeah.
So it's a typo, or actually they probably used a real company and they just.
Operations.
Yeah.
Okay.
That makes sense?
Mm-hmm, yeah.
So now it matches. And that interest expense they decided to put down in non-operating. Right? So it's like you put it here. They just didn't call it other revenues and gains and other expenses and losses. It's one line.
Okay.
It's really better to call it non-operating and non-operating.
Yeah, it would definitely make it more clear, but that's not the way it's done.
Well, some
Right.
companies do, some don't.
And I have a whole sheet of questions to ask, but I can email this to you. Like I don't quite understand controlling interest and tax and all of that.
Yeah.
Well, this is our last day, I think, on this chapter.
No,
We're
we
on
have,
5, don't we?
we're going to go on to 5, but we've got to
Go
pay
back and
both. So we'll keep talking about this next
Okay.
time, and then we'll be 5.
Okay.
I was just waiting to talk to that person.
Oh, yeah, we're going to go down to Huntsman. Thanks for reminding me. That'd be real rude if I didn't go. Let me kill this thing off. Let me save it.
All right.
I guess we'll save it, huh? And somebody like this. Oh, he's not here, might listen to it.
Present some useful stuff.
It's possible.
Here it is.